Welcome to In the Hot Seat with the Tenney Group. I'm Spencer Tenney. It's good to be with you. Today, we are joined by one of my favorite people in all of trucking logistics, Bill Prevost, Chairman and CEO of Paladin Capital, one of the most successful ESOPs in the trucking industry, paid out $88 million from retirement funds. An amazing story there. Bill, welcome.
Thank you, Spencer. It's good to be back with you.
Yes, it is good. I'm excited about this conversation. It's been too long. So, why don't we jump right in there, sir? Um, as far as ESOPs go, this is one of the most common questions people wanting to understand is ESOP right for me? What advice would you give someone who is considering a possible ESOP as possible exit channel for their business?
Uh, Great question. The advice I would give is what are your retirement goals? And are you looking out for yourself or do you want to leave a legacy? And at Paladin, we sort of target companies where they're privately owned. The owner has a tremendous reputation in the community. The company has a recognizable brand, proven record of profits, and the main factor driving the sale of the ESOP is the calendar, where the owner has reached the age where it is absolutely time for him and for his estate to monetize his investment in this company so that his heirs get everything that's due and he gets a good retirement. But by the same way, by selling it to an ESOP, he can then turn to all his employees and say, thank you for what you did for me. Because of this, you're now an owner of the company. And we look for profitable companies with proven management teams where, the owner may have been absent the last 3 or 4 years and the team has really carried the ball and run it well. And those people can continue to carry the ball. What we as Paladin Capital do is bring, economies of scale in financing, in banking, insurance, medical insurance, purchasing programs like tires and fuel. They get to scale up their business into one of our size, and it helps us grow and get even greater scale. We are not day-to-day operators. We don't run the businesses day to day, and you know, it just works. And we've watched many success stories since we've done this.
I love that. Now, I know that you look at a lot of opportunities, and a lot of people, because of your reputation, come to you to explore that. But what would you say are some of the characteristics of companies that are not likely to be a fit for ESOP?
Well, one of my truisms is the tax code drives all human behavior. And, privately owned businesses will expense things at the business level that are really personal to the owner. Now, I'll give you an example without naming names, but I went to visit a company and was looking at the balance sheet and asked about, well, where's this new shop? Because I was obviously sitting in the old shop. And they said, well, you know, we've got a nice indoor air conditioned horse training rink out on the farm. And okay, well, that's an asset that I don't think you want to pay my lease rate if I buy it. And so what they have to properly do is be in a position to separate their personal into their private, and like cars, club memberships, things like that. I think they need to remove that, and they need an advisor. And I know you advise a lot of your people to clean up their balance sheet so they have a sellable company. And that's the big obstacle is so much of their personal expenses being washed through. The janitorial service also cleans the home, things like that. The company cars, you find out the grandkids have company cars. Well, that's all nice, but when it comes time to sell, that won't sell. So those are the obstacles we get. And I don't criticize anybody. I mean, that's what does it. You try to minimize your taxable income.
Well, and obviously there's a higher level of scrutiny with an ESOP type transaction than with a traditional non-ESOP type transaction as
Oh,
well.
oh,
I think it's
absolutely. When you form an ESOP, when we formed ours in 2004, you're basically making a covenant with the United States government that you're going to give guidance of your business to the Department of Labor and the IRS. And most entrepreneurs don't want any part of those two people being in their wallet. So you got to get the company in a position to where when it goes forward, it can meet those scrutinies.
all good things. So let me back up here for a second. You teased a moment ago some of the things in terms of leveraging and so specifically addressing medical health insurance. You and I, kind of in a separate conversation, talked about some of the exciting things that you've been developing from a strategy standpoint around this area. Tell us a little bit about what you're doing in the area of medical insurance and how that's providing a benefit to your company.
Uh, I'm happy to. I'm proud to actually. Like many middle market trucking companies, uh, the last 10 years have been very challenging since the passage of the Affordable Care Act in rising medical insurance rates and rising auto liability rates. And that's the challenges CEOs have to figure out. And I've had two great things happen to us that led us to this road of success we're on. Uh, Back in early 2018, our broker brought to our office uh, an Israeli named Ron Shaw. And Ron was with a company called K Health in Israel. And even though it's K Health, the whole company is artificial intelligence. There's nobody in the company with a medical degree, but they're all brilliant at data analytics. And they had built a database in Israel of over 5 million patients in different conditions. And what Ron came to the United States to set up the American office in New York City, and they were selling an app. And it's an app on a phone tied to K Health. And you fill out your profile, and then when you have a medical condition, you enter that condition into the app, and it'll give you a diagnosis immediately up to a 98% accuracy. And if you need immediate attention, it will then connect you with a doctor. And in our medical plan, which was self-funded, one of the big things that was driving our costs through the roof was the uncontrolled emergency room use. Drivers are gone a lot. They are not good at scheduling preventive care, annual physicals, things like that. And so when they get a condition, they head to the ER. And likewise, when their family gets a condition or a situation, they head to the ER. And I looked at this app and I thought, wow, if we can use this app and reduce our ER visits, over 2,000 drivers, reduce our ER visits down significantly, we could save huge money. And every dollar we save in an ESOP goes directly to our shareholders in their stock valuation. And so we decided, we would jump on board. We would be on the bleeding edge of this introduction into the space in the United States. And so we got the app, we got it for all our employees, and we did two things to incentive. One, we made it free for them to use. And second, when we renewed our medical, we increased the cost they had to pay if they went immediately to the emergency room. Now, if Kay directed them there, that was fine. But other than urgent care, we wanted them to go through the app, for emergency basis. And it's just been tremendously successful.
I mean, that's pretty remarkable. So what I'm hearing is AI is leading to less visits, and then you're able to shift that expense in terms back to them, but the overall expense is going down because they're not using it
They're
because
not
they don't
using it. They're
because of
not
the
using
data.
it. And it's just really, and I personally have used it twice, Spencer. I've had two occasions. One time, right after we started with the app, I was cleaning the deck every spring. We live here in Tennessee. The mildew is all over the deck, and wash it down with bleach and water and soap and all that. And I got interrupted. And then when I went back to finish, I sort of had a mental lapse, and I had already poured the bleach in the bucket. And I already put the water in, but I didn't, or I thought I put the water in, I hadn't, and I didn't put the soap in. And so I was finishing cleaning the deck with pure bleach. And, about 30 minutes into that, all of a sudden my hand's on fire. And it's bright red and it's just radiant. And I'm just thinking, oh my gosh, I got a serious, serious problem. And so I hosed it off, dried off, went in the house and got my driver's license, and I was getting ready to head to the emergency room. Classic story. Getting ready to head to the emergency room, I said, oh, I've got this app. So I go on the K app, I enter all that, and they say, it sounds like you have a third-degree chemical burn, but we will really need to see a picture of it to further the diagnosis. In fact, we're going to have a doctor call you that can treat this. I said, okay, finish out on the app, and I said, I'm still headed to the emergency room. And I'm not 2 blocks from my house, and my phone rings, and it's the doctor responding from K. You driving your car? Yes, I am. Please pull over and park in a safe place. I need to FaceTime with you. FaceTime with the doctor. The doctor saw the top of my hand and the wound and how it was doing and diagnosed the wound, told me what to put on it. It was all stuff my wife had in the medicine cabinet, and then put me on a stringent dosage 3 times a day of vitamin C because skin heals from the inside out. And so, 90 days into this, my hand's perfectly fine. It completely healed. I didn't have an ER visit. I didn't lose any mobility. And it was just a success story.
I think that's phenomenal. So for our audience members, let's put some dollar signs on that. So what does that mean in terms of what's the total number of trucks, just so people can appreciate the size of your operation, and then maybe the economic savings around what does that create for
Well,
you guys?
this is just a component of what we've done. This is just a component. This cut down immediately on ER visits. But in the same year, our broker that introduced us to Kay told us about a book. The book's entitled The Price We Pay, and it's by Dr. Marty McCary. And what it really opened my eyes to was how the medical system works post passage of the Affordable Care Act, and where all the pressure points are, where all the constraints are, where all the hidden costs are. And I knew nothing about that. I was like any other trucking executive. I was buying from the big insurance companies. I was buying either, fully insured or self-funded plans, and, lasering and RX and all the other stuff. And I read this book and I started understanding it. And what I came across in the book was a concept called reference-based pricing. I didn't know what that was, but what I found out is every hospital in America files an annual report with the government, and based on the grade of that report, it determines what their reimbursement rate is for Medicare. And then I started reading further, and it started talking about the differences between what Medicare pays and what you pay in your insurance companies. And so I found out here in Nashville, there's 3 leading hospitals. 2 of them you charge 200% above reference base, but one of them charged 880%. And so you think about that variance, just take a knee replacement. Medicare pays X, 2 others charge 2X, the third charged 880X. That's amazing. And what's happened is the medical systems, we're no longer consumers. We just use it and think it's a utility like the light switch. We turn it on and our company's paying for it. Well, it's driving companies nuts to get 11 and 12, 13% medical increases. And, more claims demand more premiums. So you got to cut the claims down. And so what we did is we created or followed the concept called value-based pricing. And we literally went to every hospital in our network and we said, we will pay you 40% above the reference-based price in 30 days to take these terms. And what I learned is the largest department at any one of these big hospitals is the collections. And they can't collect their money. I mean, and so you're out offering them fast dollars. And so, as only God could provide, then another real life thing happened to me. My cousin, who's a doctor in New York, calls and says, two of his brothers, there's four boys in that family, uh, are in the hospital with blood clots behind their knee. And all this diagnosis has been done, and they determined it's through the genealogy and it's in the Prevost side of the family. Their mom was a Prevost, my dad's younger sister. And so he was contacting me and my cousin, who's a male Prevost, and saying, you got to go get checked. And I said, all right, I'm gonna test old Dr. McCary. And I pick up the phone and I call the hospital and I say, I've got to have a vein scan on my legs, especially behind my knees. What will that cost? And of course, the answer is, well, what is your insurance? And so I said, yeah, about premium plan, $3,500. And I go, oh, I forgot, I'm sorry. It used to be that, but my cheap employer, to save money, went to a different plan. And, oh, well, that'll be $1,500. Oh, okay. Premier plan pays less. And then I said, let me ask you this. If I pay cash for it the day I show up, what's it cost? And they said $750. So that shows you the, the, the amount of money that has to be built into the system because of slow payments or no payments or chasing money and things like that. And we all sign those waivers whenever we have a treatment that says what our insurance doesn't cover, we make up the balance, right? Well, little did we know what we were probably getting balanced would almost pay for the whole thing if we had done it faster. And so, I just think that, and we combine that with K, so now we had a disincentive to use the hospital, and then another incentive to bring the hospital costs down through fast payment. And in the last 3 years, we've saved our shareholders $8.6 million to the bottom line, and we haven't increased their premiums. What they pay in for coverage every week hasn't changed, and we're saving money like crazy.
I think that's phenomenal. I mean, it's a phenomenal story, I guess. And so I think what's interesting to me is as far as like selling the story to your employees who are all shareholders from a behavior modification to get the buy-in to do it. I'm wondering, like, does that happen in a company where it's not an ESOP? Do they have the same kind of a buy-in from a behavior modification to do what you're asking them to do?
I, I would venture to say they might not, they probably won't. It's just, how personal are you with your drivers? There's big companies out there that are family run or even family owned that have excellent employee relations and they communicate greatly with them. We have quarterly shareholder meetings and we try to break down every daily activity that a driver or a mechanic or somebody goes through in their day and talk about how you can create shareholder value or how you can destroy shareholder value. And, it's through, I guess now what, 17, 18 years of this, of repeating the same message and them seeing it and seeing their peers retire with nice checks that we've gotten the buy-in we have. But I think it's, everybody we employ has a family. They have bills. They know what their personal finances are like. Most of them, their wives drive that. I mean, there's no doubt the wives are the CFO of the household. I tell everybody my wife invented direct deposit because she didn't trust me from the office to the house. So I get it, I get it. Guys are impulsive, but we're all very cost conscious, and with costs rising like they are in this era of inflation, we found these two things to be a very, very powerful tool. And yes, uh, we are making strides. I heard from our broker, our new broker, who's David Massey with Brown and Brown, that uh, value-based pricing's reached 11% penetration in Tennessee already. So, it's a new wave, and I know that for the fact that what do the big guys do? If they can't beat you, what do? They buy you. And one of our TPAs that we started out with the first 2 years, and I'll just tell you the 8.6 or whatever it is total number was big in years 1 and 2, and it slid a lot in year 3. Well, that happened because they got bought by one of the big guys. And so this year we just changed that because you got to have somebody on top of it, working for your interest and not somebody else's.
Understood. So you brought up the buying. So let me finish up with this last question. Um, a lot of stuff's changing in terms of inflation. We've got global conflicts, but still, this year we're going to probably have record M&A activity. After that, I'm not sure. So where do you think the trends are going to be around ESOPs in the middle of all of this increased activity? What's going to happen in terms of the number of ESOPs up, increase, decrease? What do you think is going to happen?
I think it's going to increase. I think it's going to really increase a lot. Uh, you know, there's a whole lot of attention by the Labor Department about employee ownership. And if it's anything that gets universal support in Washington, D.C., it's ESOPs. Both parties support ESOPs tremendously. And when employees have an ownership stake in the company, they have something to work for, and it gets everybody pulling the rope in the same direction. And I think with labor shortages, and I read just last Friday in the Wall Street Journal, under the what's the initiative of society governance and accountability, that many big companies are now awarding ownership blocks to more employees. It's not the ESOP concept. They're not 100% ESOP like we are, and it's not even an ESOP minority owned ESOP. What it is just knowing you have to get ownership buy-in at different levels. Now, in the article, it highlighted all the companies that were doing it, and they were big financial firms. But, we always wanted to do it because uh, we felt like, our labor force is the backbone of America. I think during the pandemic, everybody saw how essential the trucking industry was and how abused it could be. And I think recently you're seeing a lot of positive attention that people realize what a driver's life is. And if we don't improve that life, we're going to run out of drivers. And you want to see, they're not building any more railroads, I can tell you that. Yeah, and you can just watch any train go by and you see all the number of stacked chassis trailers on them, and you'll just realize we've got to have this economy going, and it's growing. And so you got to be able to attract people, and you know that's what we try to do. Let me tell you what's coming down the road. Last April of 2021, our friends at K Health announced a merger, a formation of a new company called Hydrogen Health. It's a merger between, or it's a startup formed by K Health, Anthem, who is all the Blue Cross Blue Shield, and Blackstone Group. And so Anthem is dumping all their data in with all K's data. And Blackstone has helped funding the development and this bandwidth of all the technology it takes to crunch and give this. And K and Hydrogen are coming out with an app, a revised app, that is a primary care app. So if you look at what we've done, where we've taken away emergency room visits and hospital costs, this group has now gone to the front of that chain in primary care. and it allows you to interact. And I put some slides up to show you, but they've just take this, and in the first year, they've added 5.1 million members. They're adding marquee companies throughout the Southeast. The guy uses Bernie Livers. Bernie's here in the Middle Tennessee area. I'll share his contact. But this is just growing leaps and bounds because now you have something you can segment together and have soup to nuts. Uh, Primary care visits, urgent care visits, interactive care visits. I mean, technology is really the accelerator, and you're combining the power of technology with artificial intelligence to get better outcomes. And this will allow you to go and even have your own blood work done, send it in, and then have your physical through artificial intelligence. You'll enter all the data, and they'll tell you how you are. And they make prescriptions and everything. I mean, it's doctors. It's almost a takeoff on the teledoctor concept with tremendous horsepower. So that's what's coming down the pike.
Well, that's exciting to me. I mean, I mean, it's kind of in some ways unimaginable, but in other ways inevitable. I mean,
Yeah.
you know it's happening. I
Yeah.
mean, you know that's where we're going. And
Yeah.
so, Bill, thank you so much for being so generous with your insights and your thought leadership. Always a treat to get together and to talk trucking and logistics, and even things that are bigger than that. So that's going to do it for us on the hot seat. We thank you, sir, and we'll see you next time.